Good afternoon, everyone. It's very nice to see all of you here. Before we get going, I just wanted to say a very big thank you to Morgan Stanley and to Wilson and the team for partnering us on this event. We very much appreciate their support. And the other is a very big thank you to Grace and the IR team. Where is Grace, actually? Where is Grace? Grace and the IR team, this is a great event. We really appreciate this. I want to say this before I forget, but they always do such a fantastic job. As CFO, I have to say my favorite part is we actually originally thought of doing this event at Raffles City on the CICT property because we wanted to support our own tenant. But it turns out Tony wanted to charge us too much, and we decided to do it here because it's cheaper. Go figure. Arm's length for us. Okay, so I'm going to do the last segment of the day, which is really about how what we've talked about in our growth really translates into some of the targets that we measure for ourselves. I want to start by saying that our focus is on shareholder return. As I think Gabriel mentioned, share price is a key measure for us. We are about making sure that we deliver that return to our investors. And that means share price and dividends. And from a share price perspective, we focus on three things: growth, quality of earnings, and return on equity. And you would have heard a lot about growth today, and that's our main driver. We talk about doubling our funds under management to 200 billion. The benefit for us is we have the largest capital base of any asset manager globally, right? With 14 billion of equity and a very strong balance sheet, we're able to put that as a strategic advantage behind growth. And you heard some of that, right? We're putting more than half a billion behind SC Capital to grow. Yesterday, we made an announcement that we're going to put more than $1 billion of capital into Australia. The benefit of our balance sheet is allows us to grow for the long term. And that's really our focus for us in terms of use of capital. Tying to that, how does that work? Getting to 200B, we take this question a lot. What does that mean for earnings? So we believe that if we double our funds under management, where we look at the different component pieces, we should get to more than $1 billion in profit. With more than $1 billion in profit, higher fee income, we believe that will help drive share price for us. Fee growth, Andrew has talked a lot about where it will come from. Listed REITs, private funds in particular, lodging, commercial management. And then finally, on the balance sheet, we're going to do this through being very efficient, relentlessly efficient capital use in sponsor stakes, in the public REITs, in the private funds. And then finding a balance between making sure that we're still rewarding our shareholders through dividends, through share buybacks. I won't spend too much time on this, but we wanted to share a little bit as what has changed from us from a financial viewpoint when evaluating the company. 3 years ago when we restructured, we were expecting a lot more real estate income from our ownership stakes in the REITs or the funds. Unfortunately, that has come down with higher interest rates. With a slowdown in China. We expected to get more divestment and fair value gains, which obviously did not materialize as much, even though we have had some good sales. And then fee income growth was slower because some of the opportunities in China or with the regional funds did not necessarily materialize. So we have adjusted our approach. We've adjusted how we plan to hit our financial goals. I think one is we have a deep focus now on driving our operating profits. Right? We know that the market, if you look forward, is not going to get the same kind of fair value gains, it's not going to get the same divestment gains that we used to get for the balance sheet investments or for potentially some of the stakes in the listed REITs. So it's a focus on operational profit, operating profit for us. We've got some high return strategies, thematic funds, third party. And then on the M&A side, really it is partly like this deal that we did together with SC. It's about investing and then growing together and getting those synergies and growth out of it. So this is, for us, a shift because it affects our numbers directly. For a 200B target for our funds under management, listed funds for us now, 60%. We expect this to still grow. What you can see is organic growth. As the team mentioned, as you know, we still expect to raise capital and grow from the REITs business. But as Miguel said, particularly for some of our REITs, this is not a growth at all costs. We're not pushing our REITs to go out and raise capital all the time. In fact, if anything, We had a strategic discussion last year, and one of our REIT CEOs actually said that they didn't think it made sense for them to raise equity for the next 1 to 2 years. And we discussed it, and I think we were in agreement that it makes sense. That is the best thing for that REIT. And we want, the same way at the group level, we want total shareholder return, we want the same thing for our listed REITs. And that's the push behind, and I think something that we are very supportive of. It's the crown jewel of our franchise, and we want to build that. But if we don't grow the organic as fast as we would like, it means two things. One is there's a little bit of M&A required for the listed REITs business, but also new REIT listings. We haven't done a REIT listing in more than 10 years because it was always a capital recycling vehicle when we were a developer. But now as a fund manager, the approach is different for us, right? This is a strategic advantage that we want to leverage up and grow. Private funds, which I would say is really the two next buckets. This is going to be the bulk of our growth, right? We're talking about additional 60 billion in growth really from the private funds through organic and inorganic means. And I would say, I think Andrew has articulated very clearly where we think the opportunities are and how we look to grow that. So getting to 200B is arguably in many ways the nice headline figure for us. But what we want it to translate to is our earnings figure. So for our earnings, if you look at us when we restructured in 2021 to 2023, this is just operating PATMI for the fee business, not the total PATMI, just the fee business. And you can see we grew over the 2 years 1.4 times. This year is a little bit more challenging. Most of you who saw our first half numbers would see that it was a little bit challenging this year, but we're still growing. But if you look at us over the next 5 years, we think we can more than double this. Ideally stronger growth than that if we're able to. But we believe that by growing the different components of the business, lodging management has a public target, we think the number of rooms can increase, we think the margin can increase. Commercial management has actually proved to be one of our best growth drivers this year. When you put all of it together, we think we get to a much stronger quality of earnings from a group level. And if you see that little red bar on top, we are conscious as well that with the restructuring, we want to make sure that we're streamlining operations. Some of the new businesses are growing, some of the old businesses we are restructuring. We expect that we can get potentially 50 to 75 million worth of cost savings over the next couple of years with some concerted effort. So we're making a push across all of the different entities, and we believe this gets us to a very good growth number over the next 4 to 5 years. If you put that together with the real estate component, we think we get north of $1 billion in terms of absolute operating profit. When I say operating profit, 60 to 70%, as mentioned, from our fee business, and then the remaining 30 to 40% from the money that we have invested in our REITs, in our funds, or what we have on balance sheet. So this is also going to have to increase for us because of the capital efficiency component. We do expect this will grow, really from two reasons. One is we are now investing in higher return strategies, whether it is special situations, value add, or even private credit, where we get double-digit returns. You have to compare this to our current holdings, which are very core-focused, which, if you look at our REITs or our core funds, generally we generate between a 3 to 5% ROE. We think if we invest this into higher returning strategies, this will actually boost the component that comes from the real estate investment business. Collectively, we think that gets us north of 1B from an operating perspective. The reason I mention the operating perspective is I think if anything over the last 3 years, we've realized the world is incredibly uncertain. With changing US elections, geopolitics with China, we do think there will be parts of the portfolio still under pressure. So when we look at the fair value gains, divestments, we were previously expecting to get an uplift to our ROE from that component. Now we are working on the base case that we may get no gain there. We've put the number for China just to give you a sense for last year. For CLI China, and I would say the team did a great job in a very tough environment. But because of the fair value adjustments, despite being operating positive, we saw a negative 8% ROE return for China last year. You strip that out of the business, we were positive 6. Could we easily get that to double digits? Non-China, absolutely. I think that we're very confident of. But when you blend it together, the challenge we think is potential swings on fair values in the coming years, which may impact our financials. That is somewhat, to a certain degree, out of our control, right? Depends on how the market goes. If things improve, we can see an uplift. If things turn for the worse, it may drag us a little bit down on that component. So our focus is on the operating numbers. That's where we think that we earn our pay. So this is my last slide, and this is the one that ties how we want to deploy our capital. So maybe let me start on the left and just explain this slightly. And for the multiple people taking pictures, it will be or is already available online. On the leftmost side is our current capital employed. So capital employed for us is equity and debt. We have 8.1 billion listed fund sponsor stakes, 5.3 billion in the private fund GP stakes. This is what we hold supporting our entities. We have 4.6 billion balance sheet assets, which is down dramatically from the 9 billion we had at the start of the year. And then for the fee managers, this is actually generally goodwill that sits on our books from previous acquisitions. So surprisingly, the bulk of this is actually from our lodging business. Over the years, as we've acquired platforms from Ascot, Oakwood, Synergies, we've had a component of goodwill there. That gets us up to about 20 billion. When we look forward the next 4 to 5 years, we expect to be earning money, which is the green boxes. So we see an uplift in our earnings component. And as most of you know, we've been paring down debt with the recent divestments. So we have a little bit of debt headroom to play with as well. So this for us is the growth capital that we have. And as I mentioned, right, this is a strategic advantage for us. So where do we see this capital being deployed in the coming years? And I would say this is an end state 2028 illustrative. And I tried to put a really big illustrative there, but Andrew told me I was overdoing the illustrative component, so I've just left it at the bottom. But the idea is to show you what it could look like. There will be ups and downs on this journey because it depends on our speed of deployment. It depends on where we spend the money and what the funds are able to grow at. But if I start at the bottom, listed fund stakes. So we've come out a few times, I think, to say from a listed fund perspective, we currently hold 17 to 41% for our listed REITs. We do believe 15 to 20% is a good level for us in our listed stakes. I would like to say, I guess, two things on this. One is share price of our listed REITs is critical to us. We're not looking to do anything that would hurt their share price. So we're going to be very responsible on this adjustment. This is a 4 to 5 year journey for us. We're not going out tomorrow to sell a bunch of REIT units and impact their price. One, they are very valuable to us. I think the second thing is in certain cases, we don't think we actually have to sell anything. So if you look at the case of, say, Ascendus REIT, where we have a 17% stake, every time Ascendus goes out and does a placement, we get slightly diluted, right? And we see that as a natural evolution. So when we look at a 4 to 5 year journey, for some of these, we do think that it will just naturally get us to these levels. But we have enough capital here that we actually don't think we need very much more to grow the business. So the listed REITs at about 69 billion right now. For it to get to 100 billion, we don't think we need growth capital here. This is just becoming more capital efficient for us. Same for the private funds. Right now, we have about 40 billion worth of private funds assets under management. We have 5.3 billion in sponsor stakes. That's about 25% of the equity. If we get ourselves down to, as some of the most recent funds have, 10% stakes in the private funds, we actually have enough here to grow the entire private funds business. And when we look at this stake, this is actually, when we talk about strategic capital into SC Capital, we talk about $1 billion into Australia, it's actually coming out of this block for us. This is not M&A or investments for us. The capital is self-funding for our private funds. We don't think we need to put a lot more, right? So the announcements we make, we do it with a lot of confidence that we have, with improved capital efficiency, enough funding to grow the funds business based on the capital there, which then gives us room to play. Because we've been divesting our balance sheet, we've pared our debt headroom down, now we have funds for growth. So for the funds for growth, this is going to be used really 3 ways. First is M&A, which you saw a glimmer with for SC Capital. We expect to do more deals, and we've set aside a significant portion to grow through this format because we think we need capabilities in certain geographies, we need capabilities in certain sectors, and that's this component there. The other part there is the warehousing for new REITs and assets. So we've done this already. I think you've seen some of this off our actions over the last 2 years. We bought a Beijing office asset, which got seeded into a Beijing renminbi fund. That was 400 million of capital use, so we got the capital back. Likewise, we had what is now Life Bugis on balance sheet, 3 to 6 months off balance sheet. We've set aside between M&A and warehousing more than $5 billion of capital for this. So we believe that this part gives us great room for growth. Whether it is private funds, REITs, there is an opportunity for us to use this capital for that. And then the last component at the top is our rewarding of shareholders. And this is also, we know, part of TSR for us. And we've been pretty consistent on dividends over the last few years. We expect we have strong cash flow and more than enough capital to keep our dividends steady. Hopefully the business grows and dividends grows as well. We may potentially look at dividend in species for our REIT units as we have done in the past. I wouldn't say this is something that we will take lightly. I think we will look at this really depending on how REIT share prices are doing and how our capital deployment has been. And then finally, buybacks, which has been something that we've been doing consistently this year. I think this year we've bought back 340 million. I think we believe that we can keep run rate buyback because of the capital that we have. We can keep a comfortable share buyback run rate going forward without worry that we don't have enough for growth, because our priority is really deploying for growth. The rest, we think, just makes us more capital efficient, helps us generate that higher return for investors. So that is our outlook, and really how we think that the 200 billion funds under management, we build that to more than $1 billion in profit, and that collectively, together with effective use of our balance sheet, allows us to grow and improve our return for investors. And with that, I believe we go to questions.